We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
Politics and politicians creating upheaval the world over, whether foreign or domestic. It seems that the second oldest profession is, as Ronald Reagan once observed, acting somewhat like the first. Welcome back to Liberty Nation Radio here on the Radio American Network. I'm your host, Mark Angelides. On today's show, we discuss the Ukrainian counteroffensive, gun rights in America, the demise of the oil market, and the 2024 primary circus. I want to take a moment to say a special thank you to our listeners out in Kankakee, Illinois on WKAN 1320 AM and 103.3 FM. Thanks for being here and being part of the team. Remember, this show is proudly sponsored by LibertyNation.com, where you can access podcasts, breaking news, analysis, and a range of biting and brilliant shows to whet your appetite for freedom and your fondness for the great American Constitution. The much coveted black gold, Texas tea, oil that is facing a tricky time of late. Not content with being considered the root of all climate evil, it seems the once reliable indicators have gone haywire. So what's happening with oil? Liberty Nation's economics editor, Mr. Andrew Mann, joins us to unravel the troubles ahead for black gold. Welcome back, Andrew.
Thank you for having me.
So, Andrew, is there a supply and demand issue facing the oil markets that seems to be impacting consumers? I think that's the best way to put it, right?
Well, it's a very challenging way to assess the oil markets today, because the biggest story, of course, right now in the global energy markets was the recent OPEC meeting in Vienna. And Saudi Arabia said they would slash output by 1 million barrels a day in July. And then OPEC Plus, which is the allies of OPEC, they said that they're going to extend their production cuts throughout 2024. Now, at initially, this set in overnight trading, this sent oil markets up about at most 2.5%. But as the trading sessions went on, oil price actually fell on the June 5th trading session because of two things. One is that the demand is not strong enough, both in the U.S. and in China. And two, the investors are not seeing the global deficits happening in the second half of 2023.
So what does this mean for, let's say, American consumers, that OPEC's going to drop their production by 1 million barrels per day? I mean, that seems like quite a lot, I would suggest. And will that inflate the cost at the pump during, let's be fair, during the run-up to the election?
Well, this is actually the one that is in addition to all the other production cuts that have been happening by Saudis, by OPEC, and by Russia. Now, for your broader question, it's really funny, because if there is a recession and that annihilates demand, then that would bring the price of oil down. But of course, economic downturn can wreak havoc for everybody else. When it comes to gasoline prices, the price of oil accounts for about half of what you pay at the pump, and then in addition to everything else, refining and all that stuff. So the U.S. is not countering the loss of production by OPEC or Saudi Arabia. If you look at some of the latest EIA data, it shows that the U.S. has stagnated throughout 2023, producing between 12.1 and 12.3 million barrels a day. Now, to put this in the context, before the pandemic, the high was 13.1 million barrels a day. So the U.S. is still about short of 1 million, but where it was before the crisis. So overall, the U.S. could take advantage of this situation, but it's not.
By taking advantage of the situation, you mean ramping up production to pre-pandemic levels?
Yes,
essentially Trump era levels, let's say.
Exactly. Now, the problem is that these oil companies are not doing that based on everything we've talked about over the past year when it comes to too much regulation, too much red tape, too much litigation. And also, there was a recent report came out by the EIA. It's Short-Term Energy Outlook, or STEO, and it said that U.S. production is going to rise to as much as 12.8 million barrels a day by next year, which is again still short, but I have doubts that will be achieved, because if you look at the Baker Hughes total oil rig count that measures the number of active drilling rigs in the United States today, has actually fallen to a 14-month low. It's actually been on a downward trend for the last several months. So it's unclear if the U.S. is going to actually achieve its energy independence again, or produce as much as it did before the crisis, especially if prices do come down, which who knows if that's ever going to happen, because a lot of experts say that it could reach $100 again later this year because of global supply deficits.
But here's the thing. I think all of the issues here come from the issues within the U.S. is there's been a full government, full big business switch towards let's talk about renewables. And with renewables, the infrastructure, it's clearly not there. There's obviously a lot of pushback because this renewable stuff is not quite as green as they would have, as people would have you believe on that. And so, but what's happening is obviously it's scaring people away from bidding on new oil leases. So all these oil leases that the Biden administration talks about, many of them are useless. Some of them are going to be challenged. It's going to take months to develop, if not years. And what's happening is they're trying to do a pivot when the infrastructure isn't in place. And now, to me, that seems that the US is essentially, it's going to just have to buy its oil from outside, isn't it?
Yes, what I find interesting about that whole broader discussion is that one of the things that the Republican leadership touted during the debt ceiling agreement was, oh, look, we got permitting reform. We're going to make it easier for energy output. We're going to make it easier for infrastructure. But if you go inside the legislation, there's actually a couple of loopholes that would allow the executive branch and President Biden to appoint somebody to waive off some of those permitting reforms by citing a couple of intricacies for the environment. So this thing is not improving at all. And if oil companies were not taking advantage of $90 a barrel, what makes you think they would take advantage of $70, $75 a barrel? And one more thing too, when it comes to administration policy, the emergency stockpiles or the Strategic Petroleum Reserve, that has been on a steady decline again so far this year. I think it's about 339 million barrels. So that's not improving whatsoever, despite the administration saying, oh yeah, we're going to start replenishing again.
I want to ask you about this. Yeah, Joe Biden's been making hay of saying, well, we're going to replenish it and we're going to do it when the price is right. And it doesn't seem as though that price is going to be right, does it? At least until, as you say, OPEC's dropping this through 2024. So during this term of his presidency, that oil is never going to be the right price to counteract the amount that he's used from the reserve.
So a couple of things. So if you look at the previous administration under Trump, he wanted to buy oil when it was at $20 or $30 a barrel, which would have been, he would have bought huge amounts of crude to add to the stockpiles, but Democrats were completely against it. Now, when it comes to Biden's plan of supposedly refilling it, his Energy Secretary Jennifer Granholm, she said that they would start buying once prices were below $70. Now, what's interesting is that Saudi Arabia's recent decision, the whole purpose of that was to establish a price floor of at least $70. So who knows if the administration's ever going to start refilling it based on that maneuver by the Saudis and by OPEC.
I mean, if I were more of a more conspiratorial mindset, I'd say that Granholm announcing that we'll buy once it goes under 70, and then OPEC saying we're going to set a floor of 70. I'd say those two things are connected, as in OPEC is saying to the US, you're going to pay more.
Yeah, well,
or am I just being crazy? Should I get my tinfoil hat?
Well, if you look at some of the forecasts, even from the U.S. government, the EIA said in its STEO that the average price of oil would be at least $74 this year, and then climb to nearly $80 in 2024. Now, all these numbers will revise upward following the OPEC decision, but everything that happens to oil prices in the coming months will depend on two factors: one, China's economic rebound, and two, recession in either the United States or the global economy. Because China has played a huge role in oil markets in the last few months.
Yeah, I think just one very final quick question on China. Everybody kind of expected it to, because it's like the world's biggest importer of oil, everybody kind of expected it once it opened up again after COVID to be pulling those oil reserves in, it basically increasing its stocks, pushing the price down globally. But that didn't happen, did it?
No, it hasn't happened at all, because the economic rebound from after the pandemic, it's been weak. You look at the latest purchasing managers indexes, which monitor the trends of certain sectors like manufacturing. It's contracted for the last few months. So overall, China, its imports actually fell 16% in April, and on a year-over-year basis, actually fell 1.1%, which is the first time in February. So yes, so China, its economy isn't as strong as many expected, so that's also weighing on oil.
Andrew Moran, thanks ever so much.
Thank you for having me.
We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides. Entertaining, informative, and just plain fun. Watch Liberty Nation's The Conservative 5. Produced by conservatives for conservatives. C5's The Left Free Zone. Hosted by Liberty Nation's Lisa K. Donner. Joined by a raucous, irreverent panel of authors. Deconstructing leftist narratives. Debating the hot topics. And remembering to laugh. Join the official conservative safe
You only
space.
did that to piss Jeff off.
Liberty Nation's The Conservative 5.